Greetings and welcome to an exciting stock investment analysis video. Today we have the battle of the banks. In this video, my fellow investor, Mo of Momentum Academy, will be discussing two banks from his home country of Canada. In turn, I'll be analyzing two US banks. Say hello to everyone, Mo.
Hi everyone, this is Mo and I'm very excited to be making this video with my good friend Ben from Stock Investment Analysis channel.
I want you to tell us in the comments which bank or banks are your favorites and vote for whether you prefer to invest in the Canadian or US banks. Before we get into this video, I need to first announce the winner of the $99 subscription to Div Tracker from the contest in my last video. We have 47 people participating in the contest and the winner was Tony Bridges. So congratulations to you, Tony. Please send me a message so I can get that Div Tracker subscription to you. Also, as a quick side note, as I was going through the comments to see who won, I realized that there are a lot of comments I was never given notifications for. So if I ever miss your comment and don't reply, I'm very sorry. Make sure you like this video because Mo and I have worked very hard to bring you some great content that will hopefully provide some investment ideas and education. My goal is always to help you better understand investing in stocks than you did before, so make sure you subscribe and hit the bell for Mo's channel and mine so you never miss a future video. Watch to the end because one of the US banks is going to surprise you. Now, with that said, I'm going to turn this over to Mo to break down two Canadian banks for you.
Thank you, Ben. First, I'd like to share my two picks for Canadian banks to invest in, Royal Bank of Canada and the Toronto-Dominion Bank. The Royal Bank of Canada is the largest bank in Canada by market capitalization, serving over 17 million clients in 36 countries worldwide, including the Canada and US. RBC Bank revenue is diversified geographically, with more than two-thirds of its income coming from the Canada, followed by the US. Growth in the US market remains a key pillar for RBC's strategy as it generated 23% of its revenue in the US in 2019. RBC is the 10th largest investment bank in the US based on global investment bank fees, and they have 35 offices in 23 states. As for the Toronto-Dominion Bank, it is the 5th largest bank in North America by the number of branches, serving over 26 million customers around the globe. It operates a large US retail segment, focusing on consumer and commercial banking. Its US retail operations have expanded in recent years to make it one of the North America's largest financial institutions. Both of these banks have put a lot of emphasis on diversity and inclusion for their businesses. In fact, according to 2019 Refinitiv Diversity and Inclusion Index, which ranks over 7,000 companies globally and identifies the top 100 publicly traded companies with the most diverse and inclusive workplace, RBC was ranked the 3rd top company in the world, while TD Bank was ranked the 21st company in the world. Moving on and looking at some financial metrics. As for the total revenue for Royal Bank of Canada at the end of fiscal year 2019, it had a total revenue of $33.51 billion US dollars, showing 28% growth compared to 4 years ago, with a steady growth year over year. That said, the revenue for 2020 is estimated to decline, but to pick up again in 2021 and reach $32.82 billion US dollars based on analysts' estimates. As for TD Bank, the annual revenue at the end of fiscal year 2019 was $27.66 billion US dollars, showing 27% growth compared to 4 years ago. The revenue estimated for 2020 and 2021 is expected to grow gradually to reach $29.19 and $29.53 billion US dollars respectively. Looking at the earnings for these two banks, for RBC Bank, the latest quarterly earnings report for Q2 of 2020 shows a 10% decrease in quarterly revenue year over year. What's more, the net income was down by 54% year over year. As for TD Bank, in Q2 of 2020, it reported the net income of 1.5 billion Canadian dollars, down 52% year over year. Nonetheless, the Q2 revenue was up by 3% year over year. So TD Bank did slightly better in terms of their year over year performance for the net income and revenue. Now looking ahead and focusing on earnings estimates, the earnings per share for Royal Bank of Canada is expected to be at $5.25 US dollars in 2020, showing a year-over-year decline of over 22%. However, the earnings per share is estimated to grow by approximately 19% and 13% respectively over the next 2 years. As for the Toronto-Dominion Bank, also known as TD Bank, the earnings per share is expected to be at $3.64 US dollars in 2020, showing a year-over-year decline of over 28%. However, the earnings per share is estimated to grow by approximately 15% and 18% respectively over the next 2 years. One area of concern for these banks is that they are quickly burning through their cash. Both of them show current liabilities that are almost double the amount of their current assets. They're also showing negative cash flows of 17 billion US dollars at the moment. That said, these two banks, similar to many other Canadian banks, have a long history of surviving through difficult times and various economic downturns and financial crises. Looking at the valuation metrics and comparing these two banks to the sector median, we notice that they're not as favorable as their sector median when it comes to price to earnings ratio. Nonetheless, both RBC and TD banks are in line with their 5-year price to earnings averages. The price to cash flow is one metric where both banks are excelling, as they are showing much better than sector median results. RBC is trading at a price to cash flow ratio of 1.07 for trailing 12 months versus 0.73 for TD Bank. If you compare it to the sector median ratio of 6.69, you see a much better results here for these two banks. To gauge the fair stock price for these two banks, we applied the multi-stage dividend discount model, which is an equity valuation model with a greater complexity and practicality. We see that the fair stock price for Royal Bank is at 60 US dollars. And for TD Bank, the fair value is at 24.20 US dollars. Now keep in mind, even at the 52-week low price, TD Bank stock went as low as only under $34. But for Royal Bank of Canada, the stock went as low as $49 back in March 2020. Now I know there are a lot of dividend stock investors out there, so let's take a quick look at their dividend payments and how it's changed over time. RBC has paid dividends for the vast majority of its history since 1870, despite recession, financial crisis, and economic downturns over the past 150 years. RBC's current dividend yield sits at 4.74% and has payout ratio of 53% based on the trailing 12 months of earnings. This dividend payout ratio is quite healthy and in line with the past average payout ratio for the bank. The graphs on the right side shows you how investing in these bank stocks over the long term could pay off. In the year 2000, Royal Bank paid nearly 37 cents in dividends, which was approximately a 3% yield on the stock price of $12.06 at the time. If you had bought stocks of Royal Bank 20 years ago and held on to them, those same stocks would earn you the relative dividend yield of over 25% per year. This is on top of the 367% growth in the value of your investment over 20 years from stock appreciation, showing an average of 18% annual growth just from the appreciation alone. TD Bank has a long history of paying dividends as well since 1875. Currently, its dividend yield sits at 5.31% and has payout ratio of 52% based on the trailing 12 months of earnings, which is quite healthy. The graph on the right shows you how investing in TD Bank stocks over the long term did pay off. 20 years ago, back in the year 2000, TD Bank paid approximately 44 cents in dividend, which was approximately a 3.6% yield on the stock price of $12.32 at the time. If you had bought stocks of TD back then 20 years ago and held on to them, those same stocks would earn you the relative dividend yield of nearly 18%. This is on top of the 240% growth in the value of your investment in terms of stock appreciation over 20 years, showing an average of 12% annual growth just from the stock appreciation alone. In my opinion and based on my research, both of these banking stocks from Canada are great choices to invest in over the long term. Not only they have very healthy and growing dividend payments over the years, they also have very solid business models and they have been very well established here in Canada with markets internationally. I'm an investor in both of these stocks and would definitely continue to grow my positions in both of these two banks. Over to you, Ben.
Now let's talk about two US banks. One is a major national bank, JPM, ticker JPM. The second is a regional bank, Bank OZK, ticker OZK. Let's take a look at their earnings side by side on fast graphs. In these charts, the dark green is the earnings, the black line is the price. We would expect the black line to generally follow the dark green. As a company earns more, it's more valuable and the price should increase. Looking at JP Morgan, the earnings have grown at just over 11% for the last 20 years. OZK has amazingly grown at almost 16.5% per year. The dividend yield for JP Morgan is 3.89% and for OZK it's 4.89%. There's a massive difference in market cap as JP Morgan's is $282 billion and OZK is only $2.6 billion. Note that debt to capital for OZK is only 16%, whereas JP Morgan's is over double at 37%, but we'll get more into debt in a moment. Banks were hit hard in 2008, so take a careful look at that time period for both banks. JP Morgan's earnings dropped by 81% that year and they cut the dividend by 86.8%. On the other hand, OZK's earnings were up in 2008 by 8% and they raised their dividend by 16.3% that year. That is impressive and looks much better than JP Morgan. Looking at only the past 10 years on these charts, we see much slower growth for both companies, with JP Morgan down to 6.87% and OZK up at 9.94%. Both are seeing earnings decreases of over 50% this year, and both are expected to rebound next year. If JP Morgan returned to the normal PE ratio it has been at since 2012, we would see 15.8% annual returns with a dividend included. If OZK does the same and returns to a fair value of 15, we would see a 33.3% return, which is more than double. Looking at past performance, over the past 20 years, JP Morgan beat the S&P 500 by about 1% with 9.8% annual returns compared to the S&P 500 8.5%. OZK, on the other hand, returned 13.8% for the same time period. A $10,000 investment would have grown to $75,000, almost double JP Morgan's $38,579. Looking at FastGraph's forecasting tools, if JP Morgan returns to its normal PE of 12.44, we would see a 16.19% return until the end of 2022. Meanwhile, if OZK returns to its 4-year normal PE of 15.33, we are looking at over 35% annual returns. Before we leave FastGraphs, let me first show you their free cash flow lined up side by side. The free cash flow is in dark green, and that white line is the dividend. Why does that matter? The dividend is paid with free cash flow. The dark green needs to be above the dividend line to show that they are able to cover it. You can see both companies have periods where the dividends temporarily were not covered. The big difference is JP Morgan has had that occur in part or all of 10 of the past 20 years. The same can only be said for 4 years for OZK. Now you'll see the most recent year is white for both. That is because the data is missing from FastGraphs there. It is unclear whether OZK is covered at this time based on that chart, but JP Morgan is not. Based on data I found elsewhere, OZK is still able to cover the dividend with free cash flow. Although I do not believe this is endangering either dividend immediately, OZK has had superior free cash flow coverage of their dividend over time. Let's look at some serious numbers. Now don't get overwhelmed here because these numbers help us understand how each company is doing and whether we want to invest. We are looking for data for both companies on the PE or the price to earnings ratio. The top section is the company's earnings over time. The bottom section is the price to earnings. So which looks better? The earnings for OZK looked better up until the last 2 years. The price to earnings ratio for OZK is slightly better and is much lower than is typical. JP Morgan's PE is actually higher than historically. The PE is looking better for OZK, which is at the 41st percentile for the industry. JP Morgan is at the 67th percentile, and remember, we want this to be low. So with regard to the price to earnings, OZK is the winner. We are now looking at price to sales. Looking at sales numbers here for JP Morgan, we can see that the sales were declining from 2008 until 2016. Since then, they have done very well and grown quickly. Their 5-year growth is 6.88%, which is at the 36th percentile for the industry. OZK has a more gradual increase without any meaningful decreases throughout this period, but their sales have grown at an amazing 28.35% per year, and they are at the 96th percentile. Looking at the price to sales ratio, the current ratios are similar, but JP Morgan is at the 68th percentile, whereas OZK is slightly higher at the 75th percentile. This is the lowest it's been for JP Morgan since 2016, but it's the lowest OZK has been since 2009, showing a much rarer opportunity to buy OZK. For price to book, we can see JP Morgan's book value per share has grown beautifully from around $31 up to just over $86 per share. However, OZK has grown even faster from $2.29 up to $31.60, which is absolutely massive and far faster than JP Morgan. Looking at the price to book ratio, we can see JP Morgan is at a 1.08, whereas OZK is at a far more attractive 0.7. I'm always happy to get a price to book ratio below 1. JP Morgan's price to book ratio is currently higher than it has been for most of the last 16 years. Unsurprisingly, that means the percentile is also unfortunately high at the 89th percentile. For OZK, however, this is about the lowest it has been in decades, and this is at a very nice 27th percentile for the industry. Now let's look at price to free cash flow. Here we run into a problem we saw in FastGraphs. Free cash flow for JP Morgan is currently negative, and thus the free cash flow is at the first percentile for the industry, which is obviously negative. We can't look at a price to free cash flow ratio when the free cash flow itself is negative. So at the very least, we know this is not a good thing. Looking at OZK, we can see a slight decline in free cash flow, but it has not been negative since 2013. The 3.33 price to free cash flow for OZK is the lowest it has been with the exception of part of 2019 since 2006 or earlier. Their free cash flow is at the 85th percentile for the banks, and their cash flow growth rate for the last 5 years has been 28.5% per year, which is at the 88th percentile and very impressive. So how are they handling debt? The current ratio gives us a sense of a company's ability to cover its short-term obligations or those that are due within 1 year. We want to see this at least at a 1. We can see the current liabilities and current assets for JP Morgan have been growing. However, the liabilities have been growing even faster than the assets, so we see the current ratio has dropped to its lowest point so far on the graph. It is at a 0.89 at the time of this video, which is below the 1 we were hoping for. OZK has also had significant increases in both liabilities and assets. However, it has maintained the ratio and added assets as fast as liabilities. Its current ratio is a 1.02, which is just barely above the one we were hoping for, and OZK wins again. Let's look at debt to equity. We want this to be as low as possible. For JP Morgan, the debt has been fairly flat since 2009, and equity has been increasing, so we have seen a gradual decrease of debt to equity. It is now at 1.3. In other words, there is 1.3 times more debt than equity. That amount is quite high for banks, and JP Morgan is at the 90th percentile. For OZK, equity has grown rapidly and debt was flat up until very recently. Despite this recent increase, the debt to equity ratio is only a 0.34, which is at the 29th percentile for the industry. That's exactly what we want to see. Their equity is approximately triple their debt, which is far better. Comparing margins, we always want to see higher margins whenever possible. And we see that for gross margins on top, both are right around 80%. For operating margins in the middle, JP Morgan is a little under 30%, whereas OZK is higher at around 35%. For net margin or profit margins at the bottom, JP Morgan is at around 20% and OZK is again higher at around 26%. Let's check out returns. JP Morgan's return on equity has been fairly stable but increased slightly recently. OZK has been gradually decreasing and is now less than JP Morgan. Here JP Morgan wins as the return on equity is at the 85th percentile, whereas OZK is only at the 36th percentile. Return on assets for JP Morgan has increased steadily and is around 1% now. OZK was fairly flat until this year when it dropped down to just over 1.5%. Although I want to see returns growing, I believe this recent drop is due to the economic crisis and current events. OZK's return on assets remains above JP Morgan's return on assets. OZK's return on assets is at the 87th percentile compared to JP Morgan's 53rd percentile. Now last, for return on investment, JP Morgan has been growing and is around 5%. OZK has been fairly flat here but dropped recently and is just above 5%. OZK's percentile is still at the 67th percentile for the industry, and JP Morgan is only at the 21st percentile. I don't own either bank, but I am planning to buy OZK based on the data I am seeing. I believe this is a good opportunity at the current valuation, although I do not like some of the actions the Fed has taken in the banking industry recently. So what do you think? What is the best bank to invest in? What bank has better numbers than OZK? Do you prefer to invest in the Canadian banks or the US banks? Please share your thoughts in the comments below. I look forward to hearing from you. Don't forget to subscribe because we are creating more videos for you every week.
Thanks again for watching this video. Hope to see you next time.